Have you ever wondered why, when you're looking at a chart and it just keeps going down and down and down, if it's ever going to bounce? What about when a stock or a crypto or something just keeps ripping higher and higher and higher? And every dip, you think this is the tippity top, 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 and then it just turns and keeps going higher. What about a market that just bangs around sideways constantly? Oh, this is the breakout. Nope. This is the failure. Oh, nope, this is not. And it just keeps going sideways and sideways. So we're going to look at that right now with the bond market. So if you're interested in this sort of stuff, hit that like and subscribe button. Go to macro-ops.com and sign up for our free newsletters. All right, what we're talking about today is market regimes. And the market regimes they're actually a lagging indicator. What they're trying to tell you is like, what is the current market environment you're in? So it can tell you things like, are we trending? Are we trending up or trending down? Are we in a mean reversion environment going sideways? Things it can tell you is it a volatile regime or is it a nice, calm, quiet regime? And one thing that I'm going to look at today is the reversals. When are reversals actually available and when are they not? So looking at my screen right here, I'm looking at the different equity indices. I got Russell, S&P, the mid caps, NASDAQ, and on the bottom of the screen, I got treasuries. I got 2, 5, 10, and 30-year treasuries. And one thing that everybody has been really focused on in the macro world is the treasury markets. When are they going to stop going down? When are rates going to stop rising? So what we're going to do is we're going to take a moment, have a look at the different treasury markets, the futures of them at least, and I'm going to show you how we can anticipate when a potential reversal might happen. So what we're looking at here is the 30-year treasury, the T-bond, the big daddy. This is the big one. And basically what we're looking at here is a daily chart, and we have some Keltner channels around it up top. Down below here is the SQN indicator, okay? This is an indicator I coded up, and it's free in TradingView. Just if you have TradingView, just type in SQN, search for it. You'll see Chris D. Fallible. That's the one. Should have a couple of hundred likes on it. That the one with the most likes is the one you wanna get. And the setting I use is 100-day. You can use 22-day, 44-day, 66-day, 111-day, whatever time frame you want. But I've standardized at 100 days. Okay. And what this measures is it measures the percent change day over day average of the last 100 days. And then what that gives us is it gives us this nice little histogram type indicator. And you can see when prices are rising, the histogram is rising too. And when prices drop, you can see it drops along with it. That's not too interesting. But what is interesting is as it gets to certain peaks, that's when you get, whether it's a peak to the top, this blue, or a peak to the bottom, which is this dark crimson red color. Okay. Those are the extremes. And when you get those extremes, that's when major market reversals are possible. Okay. Inside that loop, you can have trends last for, well, this one lasted from the peak here of March 2020, and it just keeps going down and down and down. You'll see that we actually do hit points where these reversals happen here. And you can see that, yeah, starting March 2020, and it just drifted down into April of 2021. When it gets to that crimson, that dark color here, that's an extreme reading, and there will be some relief. Okay, that doesn't mean that it's going to be the absolute bottom ever in history. It just means that, okay, the volatility, the move has happened too far, too fast, and something is about to break. And that's when things start to change direction. Okay, you can see, let's go in a little bit deeper here. Back in March of 2022, this just kind of slams down pretty hard, and finally you get some relief. Okay, that relief is not huge, and let's measure it real quick. But I just want to show you that you get, I mean, that's a 6% relief. Okay, so the trend continues. That's not abnormal that you're going to continue to get trends. It's just when are you going to get counter trend reliefs? They usually, anything of significance won't happen until you hit that volatile type regime. Okay. If nothing else, it's something that you can look at and say, okay, we're trending down. I'm in a short position. Let's take a look from the August 2022 down into the lows of November. If you're using, let's say you found yourself in a short position somehow and the trend is on. There's no indication that it's done trending. And yeah, you did get a you did get a spike and it wasn't signaled by that. So there's not much you could have done to anticipate it using our regime framework, and that's not the point. The point is like when do I want to start looking for the opportunity of a decent return? You know, spike back into the regime. And you can see over here during September and October of 2023, we had this spike down into that, and that's about the time frame that the market kind of had a summer sell-off, return to reality, and we had a really nice rally in that period of time. Now, you know, we're talking about bonds here, so you know that's a 17% rally. Okay, when you start seeing that, it's worth noting because you can continue to be short the whole way through. That's great, that's lovely, and all. But if you're short this whole thing, let's say you're short from like 133 and you're all the way down to 111 and you start getting that, that's when you want to start tightening up your risk. Okay. As the markets get riskier, they get riskier at the edges. So the day-to-day percent changes actually get a lot bigger here towards the end of a move than they are at the beginning of a move. At the beginning of a move, it's, you know, very small percent moves. As you get to the end, so let's say you're doing like quarter, 25 basis point moves, 50 basis point moves up here. As you get to the end, you start looking at like 3/4, 1.5, 2% basis point or 2% moves at the extremes. And that's why these reversals happen, because it is so extreme. Somebody's blowing up or something very volatile is happening in the market and you're being affected by it. Now, the same is true on the upside. From that low down here where we bottomed in October 2023, like I said, we rallied about 17, maybe like 20%. And it wasn't until like a whole year later of September 2024 when the FOMC, the Federal Reserve, started actually cutting rates. So they signaled they were going to cut rates over here. They finally cut rates over here. And as soon as they cut rates, rates started rising. So as the price of bonds go down, the rates, the yield on those go up. And again, almost perfectly, we had maybe one day of printing that high volatility bull market regime, that blueprint. All it took was one, and then everything just fell apart. And you go to look at the difference of that high to today. We're down 13%. We're down 13% from the September highs. We're in January right now. And all it took was just one day of being up in that volatile area that it sold off. So as we go back and look, you can see same sort of thing on the upside. You had a nice break there back in 2019. This would have been back in 2019. We had a dip there. We had another one here in 2015. So it isn't just on the downside, it's also the upside. The thing about bonds is, they've been going down quite a bit. So what's interesting right now, today, this week, we printed that high volatility bear market regime. We had a bit of a bounce here into the end of the year. And then from there, it's just sold off almost completely. There was no indication that the bull market was on over here. In fact, it just stayed in neutral territory and then melted down. And so we can see how far of a meltdown we did, an 8% meltdown in just a couple of weeks. So that's pretty strong. And if we take a look at September till now, so about a quarter, that's 13%, like we looked at earlier. But we finally got our reversal set up potential here. That doesn't mean we're going to turn and interest rates are going to drop to all-time lows again and up to these levels. Doesn't mean any of that's going to happen. It is possible that that could happen here. But what this means is now we have this whole period where all of this was happening. There's no potential to buy like a bottom, a major bottom being put in. Okay. So there's no, like, you could do mean reversion trades. And in fact, we did this one on it was either the 5 year or the 10 year that when they rallied, we caught this move because it was in neutral territory. But when this started going here, there is absolutely no reason to be buying this anywhere in here. Even when it started to look like it was starting to find a base right there, don't do it. Now that we actually have this area, now I can be constructive on finding a potential reversal to the upside, a mean reversion trade, not exactly the major market bottom that everybody might be hoping for in bonds, especially if you're looking to buy a home or get financing for your business or something like that. All it says is that we are to the point where the possibility of a reversal in rates is available. And so we'll see that on that's the 30 year. Let's take a look at the 10 year. You can see that it's even far more brutal to the downside. But when we do get those reversal areas, they happen. And then they fail. So now that we have it on the 10 year, we're going to look for a potential reversal up, potential reversal trade up. We're not going to, marry this trade. We're just looking to take the trade. And if it does happen to continue to play out in our favor, we'll continue to go with it. But if it doesn't, then, we get in and we get out. Down to the 5 year. 5 year actually printed a reversal earlier, back at the end of December. We caught this trade. We went long. We got out almost perfectly with 2R on that. Just delete that. We caught that trade right here perfectly, and then it just instantly dumped again. So even though we got that major bottom reversal signal potential, it didn't really hold up. It looks like it wants more of those. So, that's fine. And that's the short duration 5 year. And then finally, we take a look at the 2 year, which really, if you were to look at the twos and tens, like the twos just fell off a cliff and then they haven't done anything. So they really got melted back in 2021 to 2023 during the bear market there. And nothing has happened on that shortest duration that we're looking at here. You can see that it printed those reversal bottoms. This is actually another key point to pay attention to. When something is so big and so massive, even though you're printing these major bottom signals in the regime, it can persist. This is a bear volatile regime, and it did persist. So by the first print to finally, well, let's see. Finally, the bottom here would have been, I guess, about there, 8%. And remember, we're looking at rates here. So an 8% move is huge on rates. But if you're used to trading Bitcoin or other assets, these don't quite move. They're for leverage. There's a lot more leverage in these markets, which is actually kind of one of the reasons that make them so fragile, because they don't move as much. There's a lot more firepower behind them. So when something happens, you see a 1 or a 2% move in rates on the day, you can know that day was a crazy day. So let's take a look at something like let's do S&P. Okay. So the S&P printed that reversal, right? We'd already exited our trade. We'd already gotten the heads up that things were very fragile here. So we exited, FOMC comes out and prints. And then, pretty much since then we've gotten, let's just go here to here, about 5% sell off on the S&P since getting our more or less getting our signal here that was a major top, and we're already back in the neutral regime. The thing about something like the S&P, unlike bonds, is you can rarely see any of those bottoming type. In fact, yeah, go back until the last time we had a major bottom in the S&P was actually during the global financial crisis in 2008. So did we get one in here? Didn't get one in 2018. Didn't get one in 2020. And you can see that, especially what happened, it just instantly reversed in 2018, and in 2020 it instantly reversed. It was painful, but it actually did not spend enough time down there to get that major reversal. The 2008 one spent, let's see, October until pretty much like, so about 6 months before it kind of recovered. Where, when we're looking at the 2018 timeframe, where we looked like we were going to get a reversal, it did it within like 2 months. And then the 2020 timeframe, 2020 was right here. So within a month or two, we were back. So on equity indices like the S&P and NASDAQ and the Dow, you rarely get an opportunity to see that bear volatile reversal on the downside. You get them on the upside quite a bit because they are just built to go up. Something like the Russell, on the other hand, which is in essence just a turd of an exchange. Let's see if I can do like IWM, because that'll give us some time back. The thing that makes Russell, like I say, the turd of an exchange, is that every time something good happens to one of the Russell's components, it gets taken out and gets put into the S&P 500. So it's always losing its best performers. And so that doesn't give it much of an opportunity to really put in these big bull type of market regimes, but you get a lot more opportunities to the bears. So, whereas S&P didn't print that bottom signal in 2020, Russell did. It didn't print it in 2018, but it did with Russell. It didn't print it. Did it print anywhere? It didn't print through those. It's just so rare that you actually see them with with this regime. So that tells you something too. That tells you something about equities, is that they are always bid. And so trying to catch the downside in equities is just, you're just not playing the most advantageous hand if you're trying to do that. Doesn't mean you can't do it. For sure, you can definitely short those markets and do the things you want to do there. But just understand that you're basically renting the short position. You're not marrying it at all. Let's take a look at metals, because we do actually have some trades forming here on metals. If we look at our world here, I have a short potential on copper, gold, silver already took off, didn't give me a chance, platinum. So they've already kind of silver and platinum have kind of already taken off. Copper's my main trade that I'm looking to get short. We're in a neutral regime, and let's take a look here. There's no indication that we are, like you can see here, that was a nice top in May of 2024. You can see the blueprint there, and the blue color print. And yeah, we had a 25% sell-off in copper. Okay. So, let's take a look at this bottom over here. From the bottom to this high, you had a 40% rally in copper. So, sometimes it's early, that top signal. All that's telling you, let's say you're getting this top signal. By the time you're in and you're in this trade and you're getting these volatile readings, your position sizing is starting to drop because the ranges are so big, but you haven't been taken out of the trade yet. And then see how quickly it dropped into the volatile regime. Now let's take a look at another trade I'm in right now. I got long corn over here, and it has. Let me just take this right here and see where we are. We're up at like 1.2 R. I've moved my stop to break even, but we did print that bull, that volatile toppy potential. So I moved my stop up here. Let's take that off. So if my stop was down here and I start moving and I get this printed, I tighten up my stops. I could still get quite a runner here out of this. We've seen numerous times in the past where, you get your first print of that top regime at 610 and it still runs to 848. Your first print here at, let's see, 400, and this thing runs before it peaks to almost 800, 750. So just because we got the little print here so far, one day today, printing in there, that doesn't mean it's the end of the move. It just means that volatility is really starting to kick up on corn, and I need to be a little more protective of my position. I could easily see this thing go to, $1,000, 800, 900 bucks, 500 bucks from here. And I'll write it all along, but I know that the as we get into a more volatile regime, it gets more delicate. Okay, and we don't really see, it was right here, April 2020, we actually got a bottom in corn, and then that bottom went from 300 to 850 by the time it peaked. We got another bottom in 2014, and that's been a long time in a neutral sideways regime. So this was really, so from 2014 to 2020, you had 6 years of just complete neutral, and you can see, we basically, the market type was neutral the whole way through. Yeah, we got a little bullish, yeah, we got a little bearish, but for the most part, it just kind of went sideways. And then here we have soybeans. So we have a bottom signal there. So the high volatile bottom signal triggered there, and I'm in long from over here, like 981. This thing's moving. This thing's really starting to move, and we do have an opportunity to see this thing really start to take off. One thing that's important, that different between this one over here, a lot of the other ones that we've been seeing for the last 2 years. The first time we've actually flipped into the bullish, a nice quiet bullish regime. So this one could actually have some good legs before we get to, look at that. I'm already in. So the potential to catch something even up into like a fib level, like a 50% retracement, takes us up to about 1,500 from like 900 entry or whatever the entry was, 985, I believe, something like that was my entry. It's just flipping over, and there is the potential to get going. The thing is, when these get started, they take a little bit of work. So it's not as easy as I'm making it sound here. But we know that we did have our bottom signals kick in, and we have flipped into the bullish regimes. So taking that cue as the regime is now favorable to, normally this would have just been an exit, would have been, right up into here, exit. But since we flipped into a quiet, bullish, trending regime after getting into the trade, now I can hand this thing over to a potential trend trade and maybe catch a really big move. That's what we're looking at right now. We have the major bottom signal potential market regime environment on the treasury markets. We have a nice trend potential in some of the commodities, such as the agricultures, ags. Metals are still in a mean reverting type environment. So until otherwise proven false, I'm going to short the rips and buy the dip. And the volatility in energy right now is pretty strong. I got stopped out of a short, and crude kind of took off with it. So that's it. That's how I use the market regimes to help identify what sort of trade strategies to be implementing based on the environment we're in. It's almost like using a market regime is kind of like the weather and the calendar. In the winter, you're really only worried about being cold, right? In the summer, you're worried about staying cool. And it's that same sort of thing with market regimes. You don't have to worry about major market tops happening if you're not in a high volatility toppy regime. Same for a major market bottom to happen if you're not down to those extreme levels. It could just keep trending. But when we get those prints, we can see that the potential for reversals are finally there. It doesn't mean they're going to happen, but we got to be ready for them. Give me your thoughts down in the comments down below. What do you think needs to be reversed? What do you think is potentially topping out? Let's take a look at them. Like and subscribe, macro-ops.com to the newsletter. Love you. Bye.